So if you hadn't already seen the news, the CPI data, which is the Consumer Price Index data, which is released by the Office of National Statistics every single month, and they do this on a rolling basis, they've just released the highest increase they've ever seen for August 2021, and that rate is at 3.2%. That means when we compare the prices we paid today in August 2021 with what we paid in August 2020, that means that those prices have risen more than 3.2%, which means that unless you've had a pay rise over the last year, then things are costing a lot more than you should expect, and your money's losing its value. The question I wanted to answer really quickly in today's video is, does this data worry us? Should we be concerned about this data, especially as investors? And should this affect and change the way we potentially invest? Well, in order to answer that question, we need to quickly look at the data. So let me just look at a few of the figures now, which I've got open on my laptop. So driving that 3.2% increase was several different areas who were mainly contributing to that. So some of the biggest drivers were the price of food, price of petrol, and of course, used cars. Now, we saw a lot of the same sort of behaviors and the same sort of figures from the US when they released their inflation data just a few weeks back. If you remember, they saw a huge bump. But of course, areas like used cars were really responsible for that major area. And of course, the used car market, it's a bit of a strange one at the moment, but I'll jump onto that in a second. So if we tackle the price of food, of course, we had a lot of the Eat Out to Help Out scheme, which was ended. And of course, the price of moving food across the country and certain shortages of food with different driver shortages means, of course, when we go to a restaurant or a supermarket, potentially you're seeing some higher prices there as the cost of goods and moving that cost of goods across the country has increased. Then, of course, we've got the increase in price of fuel. Now, I don't know about you guys, but I've seen the price of fuel at my local supermarket go through the roof recently. I remember just a few months ago when we were nearly £1 a litre, and now we're up to about 1.33 or so. And of course, fuel drives everything. So if you think we need fuel to go into trucks, to transport goods, and we need fuel to drive anything, fuel, of course, and the raw material that is oil is producing pretty much everything in terms of plastics and you name it, really, out there in the industry. Fuel's an interesting one to analyze because, of course, all the supply is really managed and controlled by organizations like OPEC. So if they increase supply massively, then they can actually reduce their prices, but there's no incentive there because, of course, they want to make huge profits. So it's a difficult one to say necessarily if that was influenced by what's going on at the moment and influenced by potentially money printing around the world. But of course, it certainly drives everything. And now if we quickly just look at the used car market, for example, very similar to what's happening in the US, the same thing that's happening in the UK. We've got a pent up demand from when things were locked down and now people want to spend again. And the difficulty with trying to buy new cars at the moment is everyone's suffering from this chip and semiconductor shortage. Because ultimately at the moment, in the same way as you're struggling to get hold of maybe the latest smartphone or certainly the latest graphics card, and companies really trying to race those out to market, cars are very much the same in that they're basically mini computers and they've got hundreds of little chips everywhere that controls all the different systems, from having the engine running to your daylight, running lights, and your windows, for example, all controlled by little chips, which people are struggling to get hold of, as there's a huge pent-up demand in the industry. The big question is, should we be worried? Well, it's a challenging one because inflation is something that we want to kind of manage and have a kind of a medium rate. Too much inflation, of course, and you end up with a situation where as soon as you get paid, your money's worth nothing. If you don't have enough inflation or you have a negative rate of inflation, that means that there's no real incentive to spend money when you know something might be cheaper tomorrow and there's no reason to buy it. So governments around the world, especially the UK and the US and other modern governments, try and manage inflation around that 2% mark, so things steadily increase rather than necessarily going too high or too low. These can then be balanced with interest rates. As you'll be aware, we're in a record low situation where interest rates are super low at the moment. And with super low interest rates means that people can take on more borrowing. That's businesses can make more investments. Individuals like you or I, of course, can buy a new house. And of course, we've seen what that does to house prices. And that helps stimulate the economy because people spend money. Then when on the other hand, if we try and balance it out and increase interest rates, of course, that incentivizes savers and costs borrowing more in terms of how much you'll have to pay back to the lender, which then, of course, reduces that spending and kind of balances out that inflation interest rate relationship. The big question you want the answer to, though, is really, does this inflation matter to us as investors? And generally, what will happen in the future? Well, the ONS certainly think it's a bit of a blip at the moment. Of course, we look at those things that's driving it, look at the cost of food, look at the cost of fuel, for example, and used cars, and actually they're forecasting that this should go down over the coming months and years. Similar to the States, everyone's using this newfound word, transitory, so ultimately saying that the inflation will pass and really will get back to normal over the next few months, which in my opinion, I'll probably be happy to say that will probably be the case, but it really is just a reminder as investors that if we have money sat on the side waiting for an event to be able to invest, the more money we've got sat on the side, the more it's wasting away every single month. And if inflation were to take a little bit of hold, having your money sat there means that ultimately you're losing money. It's also a reminder that the investments we choose will need to beat that level of inflation. So if inflation rate is around 2%, our investments need to grow a minimum of 2% per year, otherwise we're losing money. So when inflation rises to say 3 or 4%, unless our Apple stock or our Microsoft stock or our index funds are increasing by 3 or 4%, our buying power is staying the same. And that is not a good place to be. So in my humble opinion, if I was someone right now who had loads of cash on the side and wasn't sure what to do with it, you absolutely need to make sure that you're invested in something, at least some sort of hedge against inflation, whether that be even gold, but I would probably go more towards stable coins and cryptocurrencies at minimum. But otherwise, I'd make sure I was pretty much nearly fully invested in the market other than my emergency fund. And then what I would say to people potentially who are already invested is great. Keep going, because there's not really much else you can do other than making sure that your investments are growing more than inflation. And the only way you really can do that is by having a well-balanced, diversified portfolio, or you can make sure you've got some well-researched YOLO bets and making sure that they're growing. But if your money's not growing, remember, then ultimately it's losing its buying power year on year. Anyway, I hope you found the video useful. Personally, I don't think there's too much to worry about, but it'll be interesting to see what inflation data we see over the next few months as we approach Christmas and go into the new year. Certainly it is something worth looking at. It will be interesting to see which areas and which sectors start increasing in price, or if we can get back to that 2% target level that the government have set. But anyway, what's really important is for you as an investor to stay sane, stay consistent, stay invested. I'll be doing exactly just that. Make sure you have a cool head, don't make any rash decisions, and good luck out there. Drop me a like if you found the video useful, subscribe for more, and I'll see you guys in the next one.